Hello everyone, welcome to Mr. Cobb's channel and our today's topic is procure to pay or source to pay cycle. Okay, so a quick introduction before we dive deep into this topic. So I'm a member of the ACCA body and I also hold a master's degree in finance and accounting. I have 6+ years of experience in corporate finance and accounting roles in MNCs, and my skill sets include financial reporting, analysis, process improvement, and advanced Excel. Okay, and there are many more as well. So quickly coming here, so I have overall divided this topic into like process or the teams which are involved in this whole P2P thing, and then we have the steps and some relevant notes and along with the journal entries. Okay, along with the journal entries as and when they come, I'll we'll look into that. Yeah, so the first team or the process is the one second, procurement process. Second is the purchasing process. Then third is the receiving, where the goods is received. Then we have the invoice processing team or the process invoice processing. Then we have this payments team. Then we have the reconciliation team. Then there's in the back end which goes a master data team, and then we have a finance team. Okay, so 8 teams are overall involved here. So yeah, so the very first thing is like identifying the needs. Okay, so we need the need needs to be identified, and it cannot be any need. Okay, it has to have a business reason or a business strategic reason for it. Okay, so those needs will be further taken up for the P2P process. Okay, so then once the need has been identified, then a formal quotation is created. Okay, that a quotation would include that how much quantity you need, what kind of the quality you need, the timelines by when you need the good or services. Okay, so all these things will be there in the quotation. Once the quotation is ready, so these are the things over here. So once the quotation is done, then the procurement team finds the supplier or vendor. Okay, so even the finding the vendor or supplier includes a lot of things. The vendor or supplier shouldn't be in the embargo list. Embargo list is basically the list of countries or vendors with which my business will not work based on the country's policy or the company's policy or whatever you call it. Then there are sanctions and tariffs and tax policies, and all those come into picture before deciding a vendor. Okay, these things come into picture basically when you have something very big deals. Okay, there are millions of dollars involved, so even if you save a few percentage, it really has some good impact on your financials. Okay, then formal purchase requisition is created. So this purchase requisition step, or we will call it the PR, is initiated by the business partner. Okay, now who is the business partner? The business partner is basically a link between, or a person who links the my business with the vendor or the third party supplier. Okay, so this person is the one who will be in contact with the vendor, arranging everything, making things are uh, going properly, and all the documentation and everything is fine. Okay, so every deal has a business partner. Okay, and this person initiates the purchase requisition process. Then this PR is submitted for approval. Okay, now here it is, the PR is submitted for approval, and based on the threshold or the importance or criticality of this PR, it goes into multiple level of approval. Okay, if it is, say for example, if it is a very high dollar value PR, it will go up till the director's level of approval, or something which is of a very low value. Maybe the last approvals will be the finance team. Okay, who will be having the budget and all those things. Okay, so yeah, based on threshold and important, it goes into multiple level of approvals. Then one of the approvers in that approval list is the finance team. The finance team basically checks the budget, whether the team has sufficient budget, and it also does the other sanity checks. Okay, so the finance manager will be having the budget, and BP will also be knowing about that budget. Based on that, the business partner will also proceed with the deal. Okay, so the finance team, if they see that they have enough budget allocated for this particular deal, then they will go ahead and approve it. Okay, if there's not enough budget, then they can either reject the PR or put it on hold, and the business partner will be communicated about that, and the business partner may go ahead and talk to the board or to the top leadership and arrange for enough budget to make this deal happen. Okay, or make this purchase happen. Okay, so yeah, so this is here where the procurement process ends, and once everything goes fine, finance approves it, or all multiple level of approvals approves it, then this PR gets converted into a PO. Okay. Now, when it is done, if everything is fine, now this copy of the PO is sent to the warehouse department in terms of the goods related stuff, and to the accounting department. Okay, and why this is done? This is done basically for the verification purposes. When suppose when the goods are received, so the warehouse team will verify those goods based on the PO. Okay, this was what I was supposed to receive, this much quantity, this should be the quality, and all those things. Okay, then accounting team also does the verification. We'll look into this. The So now we have the once the goods and services are received based on the PO. Okay, now we record the inventory. If it is related to good, we will record the inventory. Okay, so yeah, so here it is our first journal entry which comes into picture. So how will the first journal entry look like? So let's see. One second. Yeah, so the first journal entry when we receive the inventory will be in. Now I have POs can be raised for multiple things, okay, in for the ordinary course of the business. So I'm a furniture manufacturing business. So my furniture manufacturing and the materials related to that will be my ordinary course of the business, which will come into my inventory directly, okay. And other plants and machineries and equipments will be part of my asset. And if there is some other services which I receive, maybe legal services, financial assistance for taxation purposes, or consulting or advisory services, those will come under professional services. Okay, so yeah, so I've put the journal entry for all these three situations. So if it is a ordinary course of the business, then we record the inventory account, we debit the inventory, and we credit the inventory clearing account. Okay, now why we put it into the inventory clearing account? This is done basically to deal with the volume. Okay, since the warehouse team or the the team recording this inventory may not be knowing that uh, from whom this inventory came in. Okay, or do we have a vendor created for this or not? So what they will do, they will simply they will simply debit the inventory, which will they will create an inventory, and this park this the other leg into an inventory clearing account. Okay, and the team, maybe the accounts payable team or AP team, will pick this up from there. Okay, and same goes for the equipment. We'll record the asset and park it in the asset clearing account. For professional services, we'll park it, we'll create the expense, which is the professional services account, and we'll park it into the unbilled services account, because as of now we haven't received the bills, we have just received the service. Okay, so this is how it is. Now, secondly, one second. Yeah. So the warehouse department or the requesting. Now, what is the requesting department? The requesting department basically comes into picture when in terms of the service. Okay, so I have a finance team or I have a design team which needs some services from the third party design. So there's no need of a warehouse. So the third party designer team member will support my team here, my in-house team in designing. So I my design team is the requesting department. So they will verify the kind of service being received, how much of hours has been spent by that third party supplier, the team member. Okay, so all those things. So there's two things: warehousing department and the requesting department verifies the goods or services received based on the PO. Okay, now if the services received or the goods received are not of the appropriate quality or quantity, okay, then we will do some returns in that case. Okay, so for the returns, what will be the journal entry? Okay, so the return journal entry I have kept little simple. So here it is. One second, let me just. Yeah, so it will be, so it should basically be creditors account, so we will reduce our accounts payable, okay. But if we know that nothing is, we will reduce our accounts payable, and will also reduce by crediting inventory, crediting asset, crediting professional services. Okay, so this is how we do a record a sales return, sorry, a purchase return, okay, or a return in the services, okay, what we have received. So this is what we do. We'll come back to the journal entry. 1 second. So this is also done. Now, once the warehouse team or the warehouse team is fine with everything, then they will issue the GRN, which is the goods receipt note, okay, which confirms that the goods and services are received are as per the requirement, okay. Now we come to the fourth team here, which is the invoice processing team. Now the business partner submits the invoice. So again, the business partner role is here. Business partner will be receiving the invoices via mail, or maybe some sort of portal or tool, okay, where the vendor submits their invoices and business partner picks it up from there, or maybe the finance or the accounting team may directly pick it up from there. So whatever the arrangement business is having. So in this case, let's say business partner submits the invoices which he receives or she receives from the supplier, and that invoice is submitted through a PO. Okay. Then what happens here? Business partner receives the invoice from the vendor and submits it to the invoicing, submits the invoices in a tool. Now the accounting team receives the invoice, okay, and what kind of invoice? It will be like scanned or a PDF copy of the invoice, which they will use for further processing. Now the invoicing team will do a two-way or a three-way matching. Okay, so a two-way matching is done for service related. This 1 second. So two-way matching is done for service related, and three-way matching is done for goods related. Okay. So this is basically verifying the invoice with the PO. So suppose in a service related thing, in a service related thing, the PO will be matched with the invoice, or the invoice will be matched with the PO. And for the goods related things, I know my handwriting is not good here. So the PO will be matched with the GRN, and GRN and this both will be matched with the voice copy. So this is the three-way matching. Okay. So yeah, then they post the invoice after everything is fine. The invoice processing team will book the invoice, or will record the invoice, which is recording the expense, goods received, or clear the inventory clearing tool. So now we'll come to the second entry. Yeah, so second journal entry will be recording of the invoices. Let's see what will be the entry here. So yeah, now we see that we have already recorded the expense, okay, or the inventory or the asset. We have already recorded. Now we need to record, when we are recording the invoice, we need to knock off this clearing account leg, okay. So that's what we do. We knock this off. So credit and debit, so credit here and debit here knocks off, and we create our creditors. So once we get the invoice, okay, then only we are liable to pay them. Without the invoice, we are not liable to pay them, okay. We accrue, okay, in cases we know that we have to pay them once they issue the invoice, because we have received the goods or the services. In those cases, we will accrue for those expenses, okay, for those expenses in the month or in the period we received it. But we're not yet liable to pay them until unless we receive the invoice. So once we receive the invoice, we record our creditors, which is our payables. Okay, so this is how we do it. The invoices are recorded. Okay, now again coming back here. So yeah, so now we come to the payments team. So the payments team will release the payment either on or before the due date, based on the requirement, or whatever the case may be. And also the payment goes into multiple level of approval, okay. also based on the threshold. Okay, if it is a huge dollar value amount which we are paying, it will go for approvals, maybe finance manager or the accounting manager or the payment team manager, okay, or even to the directors level. Okay, so this is what. Then there is a reconciliation team. Now, what is the role of the reconciliation team? Reconciles the invoices with the payments being made to ensure that there is no double payment or there is no incorrect payment to any incorrect vendor or any incorrect party. Okay, so this is the kind of reconciliation happens. Okay, so how the reconciliation happening? Reconciliation is basically bank payments versus AP ledger. So AP ledger, if you see over here, is comes in this part. Okay, creditors, this is part of my AP ledger. Okay, now the payment. Okay, so when the payment is done, so I missed to show you the bank entry. So let's first show you the bank entry. Once the payment is done, let me quickly show you the bank entry. So yeah, so here is the payment being done. Okay, so for based on the invoices due date, the payments will be done, and all the payments will have the invoice numbers attached to them. Okay, so these are the payments, and again, if you see, all the payments are being tied to a clearing account. Why? Because payment team might not have since the payment is done in huge batches, so it will be difficult for the payment team to, you know, tie a payment to a particular invoice in a particular vendor's account. Okay, so they will, based on the, they will get a list, they will pull a list of invoices which are due, and they will create a batches for them based on certain criteria, maybe based on regions, based on currency and stuff like that, and they will make those payment. Okay, so they credit the bank and they will debit the bank clearing account, which is also a temporarily account where the payment entries been parked. Okay, so they will do this, and then the reconciliation team will come into picture, who will reconcile these lines with the creditors account. Okay, now they will close this creditors. Yeah, so I'll just show you. There's one more entry over here. Yeah, so if you see, so sorry, where's the marker? Yeah, so if you see, this creditors will be closed by knocking off these entries. Okay, don't confuse it with these creditors, because this particular entry was for the return. Okay, this was for the return. Okay, so if you exclude this, that is why I mentioned is 1.1. So these are the main journal entry like that. Okay, these three, this four. Okay, so if you see, after the journal entries are done, just clear this thing and make it little easy for you to show how the things are knocking off and what will be left. You see, the clearing account over here is knocked off here, right? So this goes and this goes. Now, if you see, these creditors are being knocked off here. Oops, are being knocked off here. So this goes and this goes. Again, if you see, my bank clearing accounts are again being knocked off with this entry. So finally, what we are left with, if you see in the idle business situation, is the inventory asset or professional services debit. What we are left with is crediting bank account, right? So if we buy the inventory, we increase the inventory, we credit the bank. We buy the asset, we increase the asset, we credit the bank. We take the services, we debit the services, and we credit the bank. Again, all those in the middle are the clearing accounts or the control accounts. Okay, so yeah, so coming back to the reconciliation, so they will reconcile and stuff like, and there is a master data team in the back end who makes sure like all the data related to the vendors are stored in one place. Okay, Basically, the bank account details will be there, the payment terms details will be there, and all those sort of details, necessary details will be there maintained with this team, okay? To avoid, this is also done for based on the theory of segregation of duty to have better control, okay? So that the control is not concentrated into one team's bucket, it is rather distributed, okay? So yeah, so this is a master data team, and then there is a finance team or the FP&A team, which will check for every deal or for every cost center or project, that how, what was the budget initially, and what is the actual they have incurred, okay? Or maybe they initially they budgeted for something, but based on the economic or the new business change in the business scenario, the forecast changes, and then the actual was also something different. So they do this analysis, okay, where, so just one thing, where we do budget versus forecast is called a planning variance. Budget versus forecast is basically called a planning variance, and then we have a forecast versus actuals. This is a performance variance. This, okay, the budget was something, but we forecasted it to with this, but still my actuals is can be either adverse or favorable, okay? So this becomes my performance variance, and this becomes my planning variance, okay? So yeah, so this is all about the P2P cycle, and we have went little ahead, and we have the journal entries over here. So yep, thank you so much for listening and watching this video. Please do subscribe and